Hello everyone. In today's video, I want to talk about the 4 stocks that I keep buying over the last few months. And I've revealed my reasons why. I also reveal why I'm buying them in which accounts, because this is going to be really important. You really want to keep to the very end because I'm going to talk about some tax consequences and why I'm investing in these certain accounts. Hello, it's Tracy here. On this channel, I help business owners, professionals, DIY investors learn to build wealth using stocks and real estate, earn your way to financial independence, and ultimately live your best life. So if that sounds like you definitely want to hit the subscribe button and that bell notification button to get the latest and greatest videos coming to you every single week. So what I love about TD Bank, number 1, it has growth potential. It is actively expanding in the US. Number 2, it has a very attractive dividend yield and a very strong history of not only paying its dividends, but growing its dividends. So this is a very strong dividend growth stock. And number 3, it has a very strong retail banking focus, unlike investment banking, which can be tricky, as we know, since we've seen Silicon Valley Bank collapsing. Now, just a bit of a red flag. TD Bank happens to be the most shorted bank stock in Canada. Now, I don't know why. Probably suspect because it has a very strong presence in the US and because of the smaller US banks collapsing. Well, it has a contagion effect on TD Bank and the fact that they are trying to aggressively expand the US. Something to do with their buyouts recently. So there's a lot of short interest in TD Bank. But if you are a long-term investor, you believe in the banking system in Canada. To me, it's just noise. Now, the next one is Royal Bank. Okay, so let's just be honest, not so happy with Royal Bank, only because I'm actually a big client of Royal Bank and they haven't changed their platform in forever. Okay, I remember buying my first stock on Royal Bank's direct investing platform. And let's just say that platform hasn't really changed in the last 15 years. Okay. But that's besides the point. I'm investing in Royal Bank because it is one of the top 6 banks in Canada and has a very strong presence in Canada. It has very strong financials, great track record with its dividend history, its safe payout ratio, and of course, a very attractive yield. That is also compounding and growing and doubling over the last 10 years. Another thing I love about them, they're diversified. Okay, so they're diversified in that they focus, of course, retail banking, but they also have a wealth management arm. They have a commercial arm, and they also have capital markets. So it's very diversified and safe. And of course, I'm just taking advantage of the contagion effect from the US bank collapse. It's causing a bit of fear. And of course, I am taking advantage of the fear in the market. So with bank stocks not being so popular, I'm going all in and buying these 2 bank stocks. Now, the third stock is Fortis, which is a very boring utility company. I keep investing in them, not because I'm really looking for strong returns. Let's just be honest, okay? Bank stocks and utility stocks are not going to really make you rich, but I just love the safety. I'm creating my dividend snowball. And by the way, if you are looking to learn to create your own dividend snowball, I have an ultimate guide to dividend growth investing. Check it out. It's free. Okay. Check out in the link below. Anyway, getting back to Fortis. I love about them because, they've been around for a very long time. They got consistent in their earnings, which translates to their dividends, which is growing at 5 to 6% per year. They've also got a very attractive dividend yield. They've got really strong revenue sources because they are fixed contracts. It's a regulated field. It's like you buying the railroads in the Monopoly game. You could buy real estate. Of course, they're going to give you really strong rent, capital appreciation, etc. But then you could buy the railroads, which is super boring, but it's going to give you income every time, right? Well, that's the same with Fortis. That's how I feel. Fortis is like my railroad companies on Monopoly. Now, another thing I love about Fortis is that it's geographically diversified, which reduces regional risks. Something you don't have to worry about being it's only concentrated in one area. It is diversify geographically. Now, the next company is Microsoft. So I am super interested in Microsoft, not because of its existing platform, which is obviously amazing, like Azure, the cloud computing services, its gaming services, it's embedded within all businesses. Okay, so what I'm really after is because of ChatGPT, because they effectively own ChatGPT now, and they're spending tons of money upgrading their Azure so that it can connect with ChatGPT and obviously get embedded within its existing platform of business services. So for me, I'm seeing massive growth in that area. This is just like when cloud computing services were just starting 5 years ago. Now, the next big thing is having it augmented with artificial intelligence so that it helps you become more productive. So that's why I've been investing in Microsoft, and I will be aggressively investing in Microsoft in the next 6 months. Not because Microsoft is actually cheap. I just see that a massive growth potential, and with ChatGPT being effectively owned by Microsoft, it seems to me like there's a lot of growth potential, and I'm naturally a growth investor. Now, with these 4 stocks, I've been purposely buying them in certain accounts, and here's my reasons why. With Microsoft, it is a US company. It collects US dividends. In Canada, if you collect US dividends, you get taxed on it. If there's a 15% withholding tax for every US dividend you collect. Well, that applies to any foreign company where you collect foreign dividends. So the only way to avoid this in Canada is buying them in your RRSP, which is why I've been buying Microsoft bank stocks in US currency in my RRSP so that I don't have to pay the 15% withholding tax on my US dividends. Now with Fortis, Royal Bank, and TD Bank, I've been buying them in my TFSA and in my non-taxable account, which is in my corporation. So obviously the best way to optimize your taxes is to not pay taxes at all. So your tax-free savings account would fulfill that. And because they're Canadian companies, you don't have to worry about paying 15% withholding tax, okay? You could also do the same with your RSP, but I'm very purposeful with trying to protect my RSP, especially if I'm buying US dividend paying stocks. I try to hoard that into my RSP room, which every year there's only so much room in it. And then because I want to actually purchase more TD Bank and the Royal Bank and the Fortis, my TFSA doesn't allow me, to really put in the amount of money that I really want to put into this year because, let's just say I'm trying to take advantage of the fear of bank stocks. So I've been really putting in a lot of it into my corporation. And I understand, obviously, if I buy any stocks in my corporation that pays dividends, I also pay taxes on those dividends. Now, the reason why I've been buying them in my corporation is because when I'm fully retired, which I don't know when I'll ever be fully retired, but say I am, then there'll be a point where I want to be in the lower income tax bracket because I can control the income sources that comes to me personally. And so I want to be in the lowest tax bracket. And when you're in one of the lowest tax brackets, you pay very little taxes because we are so lucky to have the Canadian tax credit. Now, if you want to learn more about the Canadian tax brackets and the Canadian tax credit, which means you could potentially pay $0 on your Canadian dividends, potentially up to $100,000, check out that video up here. Now, if you want to learn more about Ultimate Guide to Dividend Growth Investing in the link below,